All right, warm welcome everybody to today's Fusion Market Week Ahead webinar. So let's just quickly do a quick audio and visual check just to make sure that everybody can hear me okay and see the screen okay. If you guys can just pop something into the Q&A, just let me know if everything is working your end, and then we'll get started with the session shortly. Great to see a couple of familiar names in here. Thank you so much for joining, guys. Really appreciate it. Okay, fantastic. Thank you. Thank you, Bazad. Thank you, Arnas. Appreciate that. All right, so let's get started with it. Just a quick disclaimer before we start. None of the content shared in today's Fusion Markets webinar should be considered as financial advice in any way, shape, or form. All the information shared is only general and educational in nature and is my personal view and analysis of the market and does not represent the views of Fusion Markets. Also, nothing shared in the webinar should be taken as a solicitation to buy or sell any financial instrument. Okay, so with that out of the way, let's jump into things and get moving. We've got quite a lot to cover today. The first thing that we need to talk about is what happened over the weekend with the Japanese election. Now, for those of you who don't know, over the weekend we had the Japanese lower house election, and the expectations for this was that the current PM Takaishi, was going to get a victory. Now, what we didn't expect was a massive landslide victory like the one that she got. But let's quickly talk about the yen specifically, because that, as well as the Nikkei, is our focus or first focus for today. Despite the recent push lower that we had in dollar yen a few weeks ago, obviously on the back of fresh intervention threats, the dollar yen is right back up, very close towards that 158, once again testing the Ministry of Finance resolves. Now, as we mentioned at the time, the rate check that we did, that we had, it didn't do anything to change the fundamental reasons for why the yen had weakened over the course of the last few weeks, right? Or over the course of the last few months, for that matter. And with a lack of follow through from them, the markets basically, they're back on the carry trade bandwagon, right? Saying that, okay, nothing has changed. There's still massive fiscal policy coming. It should lead to further downside in bonds, further upside in yields, and obviously further weakness for the Japanese yen. Now, there's two other drivers pushing the yen lower and obviously pushing the dollar yen higher. Firstly, we had the PM's comments last weekend saying that a weak yen is actually a good thing for exports, but ignoring the fact that they are obviously struggling with a massive structurally weaker yen. And as a result, there's a big cost of living squeeze in Japan right now, which obviously is made worse by the weakening yen. Secondly, there was bearish pre-positioning on the yen heading into this weekend's Japanese election, because like I said, many anticipated that the PM will get a victory, but we didn't anticipate the size of the victory. She got a massive easy two-thirds landslide victory. So those are two things on the fundamental side of why we've seen the dollar yen push higher despite that intervention threat from a couple of weeks ago. Now, according to the exit polls, like we said, the PM is projected to win very close to 300 of the 465 seats, well above the 233 that she needed for a majority. And what this means for the PM is it means that she now has the freedom to enact and introduce her very aggressive fiscal policy. Now, remember, it was this fiscal policy in the first place that has been seeing massive downside for Japanese bonds and obviously upside for Japanese yields. And as we've explained many times, normally when yields go up, you expect your currency to go up as well. But there is opportunities or reasons, bad reasons for yields to go up, in which case it wouldn't be positive for your currency. And that's obviously what's been happening to the Japanese yen. So where are we right now? We've obviously seen a bit of a gap to the upside in the dollar yen. Let's just see if we're currently trading on the Nikkei already. There we go. Nikkei, very, very solid gap to the upside there as well. Now, these gaps was expected on the majority victory, but to be honest, given the size of the victory that she got, the expectations that we had coming out of this or coming into the open was that we would see far more aggressive gaps to the upside for the dollar yen as well as the Nikkei. So I'm not sure whether this is markets telling us that maybe a lot of this was already in the price going into it. Again, markets was expecting a victory, but not a massive landslide like we got. So where does this leave us for the dollar yen as well as the Nikkei? When it comes to the dollar yen, Look, it's a tricky one right now because whenever there's a gap, it does increase our risk of, if you from a fundamental point of view, people will want to get long carry here. Because if we do see the PM enacting these aggressive fiscal policies, that should further weaken the yen. So fundamentally, there's no reason for us to be wanting to short this thing, right? There's only upside potential from a fiscal point of view, further stress in the bond market, and obviously upside in yields. However, the problem that we have, which we had a couple of weeks ago, is that the moment we start pushing into that very same 159, 160 psychological level, let's just go here to the daily. These markings that we have here is from prior intervention. Every time we got into this danger zone, we've seen the Ministry of Finance freak out, and they've obviously issued massive amounts of intervention around those levels, pushing dollar yen lower. So it's a very, very tough situation here because fundamentally you want to belong this thing based on the PM's victory. But from a pure risk point of view, you have to wonder, where do we push into to get the Ministry of Finance attention, and where do they start to step in? There's also something else to consider. This type of landslide victory, now that she's won by this majority, and she can basically do whatever she wants from a fiscal point of view. Maybe the Ministry of Finance turns around and says, you know what, it's actually not worth us trying to stop the bleeding. It's just going to continue. We're going to be, wasting money if we do this. Maybe just allow it to weaken a little bit further. So even though 158.50 to 160 is that danger zone area, the danger zone might have moved higher with this whole political situation. So the thing that we need to take away here, there's a couple of different ways you can look to trade this. If you are very, very aggressive as a trader, then obviously, looking to get long dollar yen at the open, it's already seen a bit of upside. You can easily define risk just below that 156.50 and potentially look for a move back up towards 159 and basically testing your luck, right? Because the risk that we have here is if we trade this higher into these key levels of overhead resistance, is that at any time we can get another rate check or we can get actual intervention coming out from the Ministry of Finance. So it's going to be a very risky play. If you are currently long yen pairs or dollar yen or any other variant of that, from a fundamental point of view, it's looking very bullish. Momentum is looking very bullish, but the big threat that we have is that possible intervention. So just keep that on the radar. Again, I would think that this victory allows the carry traders to further push this to the upside, but you have that overhanging risk of intervention that makes this less attractive to trade, right? I think in my honest opinion, the simplest way to express this victory from Takaishi is with the Nikkei. I mean, just take a look at this upside that we had last week in the Nikkei. The close in this thing was absolutely beautiful to behold. I mean, we got up to 56.50. Currently, we're trading at 58. It's just a monster of a move. Now, the problem with these things is if you have gap risk, right? It's not uncommon for these gaps that we do get after these big breaks to get filled, right? We've got a couple of very good examples here to look at on the chart. The risk, though, is that there's oftentimes been gaps which the markets doesn't fill, right? If there's a good enough reason for this to continue pushing up, like, the PM's victory, then it's tough waiting for a gap. But you also don't want to be the person that buys right at the highs and then seeing the gap eventually play out. The other risk that we have with getting into something like this is you obviously want to be able to define your risk at a level that makes sense, right? And on the daily chart, especially after a move like this, you have to ask yourself, if I get long this, where am I wrong on this trade? And the answer is just below last week's low. The reason for that is, if this is indeed positive for Japanese equities, which right now is my base assumption, if this is positive, then you don't want to see price trading below Friday's lows, right? Because that's where the market started to price in a victory for Takaishi. So if we were to break below the low, that tells us very easily that, okay, I'm wrong with this trade. Now, here's the problem that we have with something like this, right? Let's just assume long entry from current pricing. That gives you a very, very, very wide stop to work with, right? Your 1-to-1 on this puts you at 63.60, which feels miles away. So I think the way that I'm going to be personally looking to take advantage of this, because again, I think dollar yen, It makes sense, but it's risky because you've got that overhead intervention risk on the radar. When it comes to something like the Nikkei, you don't have to worry about intervention risk, right? It's something that you can look to trade from a pure economic, from a pure fiscal policy point of view. So one thing that we could potentially do instead of looking at a daily is just dropping down to some smaller time frames and saying that, okay, if I was to enter this thing on a smaller time frame, I might be able to limit and define my risk a little bit tighter. Again, the best place to put it would be below Friday's low, but if that is miles away, we could potentially look for short-term gap fills if we are lucky enough to see one. So let me just draw this out for what we could potentially look for. So we could look for a possible counter rotation back down, retesting those prior gaps, filling the gap, and then looking for a move back to the upside. That gives us an opportunity to limit and define risk a lot tighter for a market like this, and allows us just on a trade like that, just targeting session highs to easily get a 1 to 2, as opposed to waiting for a gap or waiting for an extension all the way up to 63.60 just to be able to get in on that. So I'm really setting a couple of alerts around the gap. Again, the risk that you have with this is that you kind of feel obligated to wait because you don't want to be buying at the highs. You basically risk being taken out very quickly if you do. The other risk, if you wait, is that you might not get a gap fill, right? We might have to wait 3 weeks to get a gap fill on this before we get that opportunity. So if we are lucky enough to get that, that is an alert that I'll be ready to set and something that I'll be looking to take advantage of throughout the week. So I think Nikkei, dollar yen, definitely in focus. Again, nothing wrong looking to trade the dollar yen right now. You just have to be okay with being able to withstand a massive rug pull from the Ministry of Finance, right? The last thing you want to do is being long dollar yen for them to come out with intervention. Remember, intervention can see dollar yen move in excess of 350, 400 pips in about 5 minutes. We're talking about monster moves. And if you are trading leveraged, and you are on the wrong side of that move, you are going to get your face ripped off, right? So you need to be very, very careful. But that's the first key focus point. Just quickly also, I see there's a couple of questions popping in. We will make sure to have time at the end of the webinar for Q&A. So just save all of those questions, pop them into the Q&A as we go through the webinar, and we'll make sure to cover all of those. Now, the other one that I want to talk about is the pound. The pound dollar specifically, but also just pound in general. It's not often that a currency doesn't really respond to a decent shift in central bank policy when we see a big shift in central bank policy. So let me just quickly show you guys what I mean. Let's quickly go to the Bank of England here, because last week we had the Bank of England policy decision. Right. And what normally happens when you have a decent shift in central bank policy, think about what happened to the RBA last week. They came out a lot more hawkish than I anticipated. Right. I didn't even think the bank had it in them to hike rates. Not only did they hike rates, but they also delivered very hawkish forward guidance for policy going forward as well. Now, that saw a huge rip to the upside in the Aussie dollar across the board. Now, the vice versa of that happened to the Bank of England, right? The Bank of England came out a lot more dovish than what the markets had anticipated. That means we had a 5-4 vote split with 5 people voting for a hold, but 4 voting for a cut when the market was only expecting 2 of them. We had a dovish revision to the downside for GDP, a dovish revision for unemployment, a dovish revision for inflation, and we had a dovish revision to the bank's interest rate expectations, with the bank saying that it's likely that they'll need more cuts this year to basically keep the economy on track. Now, even though we did have pound weakness afterwards, it was only marginal. You know, if you take a quick look here at how this traded, let me just show you guys what I mean. Let's quickly do a cross-asset view here, and let's just look at the pound last week specifically. So if I just zoom out, let's go to the second, and you guys will see exactly what I mean. Now, pound is this light blue line. Now, we can see weakness going into Thursday's session after the Bank of England, but we recovered a little bit, right? We didn't see additional follow-through for pound weakness like you would have seen the opposite happen to the Aussie dollar, which is the dark blue. So I think the markets has a little bit of catch-up potential to do when it comes to the pound. I think there's more downside to be had for this. Now, whenever we do see a muted reaction for this, for a move like that, right? If the bank comes out with a clear dovish tone and we don't see strong downside, your first question you need to ask yourself is that, okay, firstly, was it actually dovish or was I wrong? Now, it was definitely dovish because if we take a look at how central bank expectations shifted, um, last week before we had the Bank of England, market was only looking for about 35 basis points of easing. So only one cut fully priced in. Now, after that decision, the year-end pricing suddenly jumped to negative 45, meaning the markets are very close to pricing in two full cuts, with the first one now very close to price for April and about a 55% probability for a move in March. That is a lot more aggressive. You can also see this looking at the curve. Now, this is showing you the policy path expected by the markets. Now, the red line is a week ago. The green line is a month ago, and the blue line is current. You can see how bearish or lower this shifted across the curve going out towards the end of the year. So it was definitely a lot more bearish, a lot more dovish than what the markets anticipated, but we didn't see the pound respond as strongly as you would expect. Now, whenever that happens, the first place we need to look is at positioning, right? Is it possible that the market was just already too bearishly priced for that asset to see a continuation in downside? Now, if we look at pound positioning, that is not the case at all, right? Pound positioning is very close to neutral. We actually were very bearish a couple of weeks ago, and the markets have trimmed those short positions and added long positions by quite a decent margin. So we're nowhere close to stretch short territory for the pound. We can see we're very close to neutral. So it's not like the markets was too short, which is why we saw a limited move. I think the markets just have a little bit of catch-up potential. Now, unfortunately for me, it seems like I've chosen the slowest horse in the barn or to run this race, because even though pound dollar had a little bit of a retracement, some other pairs had beautiful moves to the downside for the pound. If you take a look at the pound Aussie, obviously on the back of the RBA, beautiful move to the downside last week. The other one, and the one I want to focus on this week, is pound Kiwi. Beautiful push to the downside, and we're currently still trading very close to the lows from last week with a little bit of a gap to the downside. So I think there's more downside to be had. Firstly, because there's a very clear central bank policy divergence between these two currencies. What do I mean by that? If you take a look at the central bank expectation path for the Bank of England, if you compare that to the Reserve Bank of New Zealand, it's the exact opposite, right? Markets expect the RBNZ to hike rates. Markets expect the Bank of England to cut rates. You get that very clear policy divergence. Similarly, we know that the pound doesn't have stretch positioning, but the Kiwi dollar actually do have stretch positioning on the short side, meaning that if we were to see more upside, the markets are nowhere close to being stretched here. We're stretched to the downside, meaning there's a lot of catch-up potential for the Kiwi higher. Apart from that, if you take a look at retail positioning, now this is always a very interesting measure for us to watch. This is the thing that shows us where the retail aggregate is currently sitting with their positions. And we can see that they are currently very long this pair. That is exactly what we want to see. Because remember, when you look at retail positioning, that is always an inverse, you always use that as an inverse trigger or inverse signal for the markets, right? So if everybody is bullish, you potentially want to be bearish on that asset. So this is very bearish for the Kiwi, for the pound Kiwi. Exactly what we want to see. And there's also a couple of differentials that is pointing to potential downside risk for the pair as well. So that brings us back to the chart. How can we look to trade this? Now, it's a challenging one, this one, because you could potentially, because of everything that we just shared, right, there is potential to simply trade this from a pure momentum point of view and a pure long-term point of view, saying that, okay, based on all of the things that we just mentioned, there is arguably more downside risk than upside risk for the pound Kiwi. Now, where do we get in? Do we get in at the open and potentially anchor our stops higher? If that's the case, we might get flushed out on a pullback back into key levels of resistance before the actual move takes place. So if we do jump in, you've got a risk of being flushed out. If we don't, we run the risk of missing a very big drop all the way to the downside to 223. So it's a little bit It's a little bit of a challenging one, that one. I don't know whether I have the appetite for getting in and watching it pull back all the way, because even though we had a bit of a pullback a couple of sessions ago, we are yet to really exceed this thing, see this thing provide a credible pullback for us to use as a better level to define risk. So a couple of different ways we can look to do this. In the medium term, we could potentially look to just simply wait for a retracement, right? So we can use recent highs, recent lows, and let's just say for whatever reason we decide to turn higher. We can look at either the 23, which coincides nicely to these prior lows, key levels of prior resistance. That could be a nice level to get back into the downside. If that's the case, also from an extension point of view, let's just assume that current low is close to where we stall. If we do manage to push back into that 228 level, we could easily see an extension back down towards the zero, and then potentially see an extension all the way back down towards 225, 224, maybe even 223, right? So a pullback, I think, provides us with just much better risk reward on a trade like this. It's very difficult to just get in and ride it unless you are able or willing to sustain a much wider stop, which again, doesn't make a lot of sense in a trade like this, because let's just assume price pulls back all the way into this key level around 228. Even if we pierce back above this, that doesn't mean that we are wrong on the overall direction, right? You might just be in a corrective move in this very impulsive trend that we've seen. So we could easily see the markets do something like this and push all the way back down, which makes limiting risk here tricky. Where do you put it? Do you put it above this one? Do you put it above this one? Do you put it over here? Do you put it over here? There's so many places here where it wouldn't make you wrong if the markets trade into that level. It would just make your timing wrong, which obviously isn't ideal. So my preferred way to trade this, there's a couple of different things to look at. We can see here that this blue line is representing the average long position for the retail crowd. That means that this red box that I have highlighted here, you just know in your heart of hearts that all of these longs, or majority of them, is going to have their stops just below the recent lows, right? They want a nice little bit of a pop to the upside. So the risk that we have here is that if we just zoom in a little bit, what happens when you have a ton of stops around the key level? And we know where the long positioning is sitting, right? So this gives us a very good example, or very good idea of where stops will be sitting, is you might get a bit of a liquidity cascade to the downside, meaning that as all of those stops gets triggered, you basically perpetuate further downside in the pair, right? As all of that liquidity gets filled, you basically have a little bit of an air pocket, which could see us break below this level. So there's two ways in the short term that I'm looking to potentially trade this week. Firstly, we could look for a break of that key level, right? So wait for a break of this, and then wait for a retest of this area, right? You can define and limit your risk very easily with that 226 level. If we break through this and we manage to break and close back above that level, you probably don't want to be short unless you then start seeing bearish signals back to the downside. So that is the first possible one. Wait for a break, wait for that little bit of a volatility cascade, wait for a pullback, and then push lower. This pair, from a technical point of view, has respected the markets quite a few times on those key levels, right? We always have that retest. Take a look at what happened back in 223.50. So we had that. Let me just highlight that for us. We had that possible break, had the break, retest, and then push lower. Breakout, retest, try it again, retest, push lower. Here we didn't manage to close below, so that one is irrelevant. If we move over to this one, plenty of opportunities here. Breakout, retest, retest, retest. I mean, many times the market retested that level. So it's not unheard of for us to want to wait for that break, wait for the retest, and then use a rejection around that zone as a possible move to the downside. Alternatively, let's just say that we don't get a break of this key level of support and instead we push up. We could simply wait for any type of pullback, right? Either back up towards the 227 and wait for a move to an extension back to the downside, or potentially wait for a deeper pullback to 228 and then look for a possible move lower. My preference is to stick with this one for this week. I just think that's a simpler one. I think from a liquidity point of view, that makes the most sense, right? If the markets are that short, that long the pair on the retail side, like we looked at, If they are this aggressive, the odds are skewed towards the markets just flushing that level and then potentially using that as a flush and a retest for us in the short term. Now, the other thing you could do, and this isn't really my preference for this week, just because of the overwhelming bias on this pair. The other thing you could do is just wait for the GDP data that we've got coming up for the pound. Let's just quickly take a look at that. GDP data could be interesting because it is the preliminary quarterly data, meaning it's the first look that we get at quarterly GDP for the UK. Let's just quickly go there. I think it's on Thursday. Here we go. So this one could be a trigger. If it's much worse than expected, we could obviously use that as a trigger to trade pound Kiwi lower. But that's only coming up on Thursday, right? I think the risk that we have is that if we wait for that data, like I normally prefer to do, we might miss that possible breakout retest opportunity. The other thing that we could see is if it's a slightly better than expected GDP print, that might be the thing that pushes us back up into that level, right? So we could see the pair potentially break through this level. We get better than expected GDP data that pushes us back into that zone, and then we can use that pullback as an opportunity to trade back lower. So that is the way that I'm looking at the pound. I think in the aggregate, the bias is tilted to the downside for sterling, especially looking at the budget and how that is expected to impact growth in the medium term, as well as the dovish shift from the Bank of England. I struggle to see very good reasons to be long the pound at this stage. Now, the other one that I am still currently trading is the pound dollar. That one is currently underwater, though. Happy to hold this one. The big risk that I have for this is really the US dollar, because even though I expected more strength for the dollar when we had really good ISM data, the jobs data that we had last week in terms of jobless claims and the ADP, that didn't come out very good, right? That's why we saw the dollar retracing a little bit. So I am still expecting upside for the dollar. I think the markets got way too short the dollar at the worst possible time on the institutional side. If we quickly go to the dollar aggregate here, let me just show you guys what I'm talking about. Dollar aggregate, you can see, is currently sitting in fairly stretched negative territory. So the risk of a squeeze higher is definitely there. And that brings us to one of the key events for this week for the dollar, and that is, of course, NFP. Remember, we would have gotten NFP last week, Friday. As we mentioned in last week's webinar, there was always the risk that the government shutdown potentially saw an extension or a delay in the data. The BLS, which is the Department of Labor Statistics in the US, the Bureau, they confirmed that they will be delaying the data and we'll be only getting that data on Wednesday. So that is why we're getting NFP on a Wednesday instead of last Fridays, because of that government shutdown. Now, in terms of this NFP, there's going to be a lot more focus on this because of the jobless claims data that we had. The jobless claims came in pretty ugly last week. Job opening data came in pretty bad. We printed at 6.5 million. That was the lowest since COVID. And then obviously we had the ADP data coming out with a 22,000 print below market expectations as well. The markets didn't like that at all. Obviously the pound didn't like that at all, as you would expect. So that is putting this NFP data for this week under the market's microscope, right? The markets will be looking at this and saying that, okay, that weakness that we saw in job openings, that weakness we saw in ADP, will we potentially see a follow through of that in the jobs data? It's tricky to want to be long or short the dollar on the back of that. I am currently doing that exact thing, obviously, with my pound position. That is a risk that I am willing to take. But the risk that I have is that we go into Wednesday, the data is absolutely horrendous, and the pound dollar just rips to the upside, right? So that is a risk we need to watch, but I am currently still trading that. And, the way that you can look to trade that, I think, is very simple this week. If the data, you basically want to have a strong and a weak currency you want to trade against the US dollar. If the data comes in really, really good, meaning we see upside surprises close towards the market's maximum expectation for jobs, close towards the minimum expectation for unemployment, right? If it's a solid, good print, I would just basically hold on to my pound dollar trade that I'm currently trading. I do want to be short the pound, so I can do that versus the dollar if the US data comes in really good. Alternatively, if the data is ugly, and I mean really ugly, we get, close to the market's minimum expectation, we see the unemployment rate pop to the upside. If it's a very, very ugly print, the market's saying that, oh boy, we've got some real problems, and the market starts pricing in higher probability for cuts, for the FOMC, then we could potentially look to pair the US dollar against the Kiwi dollar. Again, we like the Kiwi to the upside for the reasons we explained. Growth is looking good. Inflation is looking steady. Recovery signs are there looking at the PMIs. We have the markets expecting hikes from the bank. And the markets are currently, from an institutional point of view, still short the Kiwi dollar. Right, so there's a lot of upside potential for the Kiwi, I think, in the weeks ahead. So looking to trade the Kiwi dollar higher on the back of a very weak NFPs feels like the appropriate counter option to choose if the data is really weak. Levels to aim for to the upside would be that 60-80 high going back to the 29th. And if we just go to the daily here, let me just show you guys this overhead resistance. After we break above that, the next one that we have to focus on is that small spike high that we have going back to July last year around the 61. If we manage to clear that, like the next key level to watch would be all the way up to 62 or 60. 62.20. So there's a lot of runway is what I'm trying to say if the data is really, really weak. Obviously, because I am long the pound or long the dollar versus the pound. Selfishly, I'm hoping for the dollar to come in for the data to come in really good this week. But we'll need to wait and see how that plays out. Now, that also brings us to the other charts I quickly want to look at for the week ahead, and that is US equities. I mean, what a monumental recovery. Equities, it was an interesting one last week. We had chunky drops to the downside initially, especially for the S&P and the NASDAQ, which was dragged lower by technology. Now, the reason why technology was lower was because the markets was really stressing about AI capex as a theme, right? We saw the markets doing a very typical rotation into value and cyclicals at the start of the week because we had very good ISM data, right? That's why I wanted to be long the dollar versus the pound, because the ISM data that we had was solid, very good ISM manufacturing, very good ISM services. And then came Thursday, which gave us two things. Firstly, we had a double whammy because first Amazon and then Google, or first Google and then Amazon, announced massive more AI capex spend. Amazon announcing 200 billion, Google announcing another 185 billion, just massive numbers. That obviously sent technology into another tailspin. And then on top of that, we had that bad job openings and the ADP data, which saw not just technology struggle, but that translated into weakness across the board. Everything sold off on Thursday. And then came Friday, which out of the blue, we just saw markets buying the dip in the most aggressive way that I've seen in quite a while. I mean, that recovery was just absolutely ridiculous. So where does this leave us now? It looks like the markets basically used to push to the downside as a bit of a bargain buying spree, right? They looked at a few of those big popular names. Let's just go there, for example. I mean, if you take a look at something like Microsoft, take a look at where the stock is still trading, right? We're down to 401. There's massive runway here to the upside. It's not like earnings for these companies were bad. Earnings was solid for Microsoft, for Google, for Amazon. We didn't see bad earnings. The market simply looked at the capex and said, "Oh wow, these guys are probably spending too much money." But if you look at the earnings, just the earnings itself, there is really nothing to worry about, right? There's a couple of things I think still going very positively here for equities. Firstly, we've got implied volatility in the form of the VIX back down below 20. That opens up some of those vol-controlled funds, which might have been a little bit restricted in adding longs. They can now add back to long exposures because volatility is more manageable. You've got growth in the US, which, yes, despite the data that we had on the labor side, overall growth dynamics is still very healthy, right? GDP is tracking at 4.4%. You've got still upside on the City Economic Surprise Index. Earnings, like I said, there's been capex issues. That freaked everybody out. But earnings itself, looking at revenue, looking at EPS, was very positive. And yes, we always have people shouting from the rooftops about overvaluation when we look at charts like this. But if you just zoom out on the NASDAQ, right? If you zoom out on the daily on the NASDAQ, overvaluation has been a concern all the way back to the global financial crisis. Since when was that a reason not to be invested in things like equities in the long term? So Where does this leave us? Now, for those of you who've been, following me for a while, you'll know that I have a very specific way that I like to trade equities from a long-only perspective. That means not short-term, but in the medium term, long-term. I'm sure all of us has pension funds, all of us has long-only accounts. I've got a very specific rule. If the overall macro conditions for the economy in the US is good, meaning growth is solid, there's not massively restrictive policy, inflation isn't running rampant. If the overall macro picture is good, I like to add to my long only exposures with every 3% drop that we have in something like the Nasdaq and the S&P, right? That means that from all-time highs, whenever we are down 3%, that basically gives me an entry in terms of long only, and the drop that we had back down to 6% on Friday gave me another possible entry to add. That's exactly what I did, right? And that's something that I'll do every single 3% drop that we get. If it's a very bad macro situation, like the one we had back in April with tariffs, where things were very uncertain, you don't know where the economy is going, there's too much uncertainty, I simply double my threshold. So instead of a 3% drop, I'll wait for a 6% drop, and I'll add every 6% drop that we get, as long as the macro picture is ugly. So that's exactly what I did. Now, if you don't if you don't feel comfortable doing that in long only, there's obviously some short-term opportunities to look at as well. How can we look to trade something like this in the short term? The biggest challenge that we have with these is that with the move we had on Friday, it makes it very difficult once again for us to limit and define risk. Where on earth do you put your stop to make this thing make sense from a risk reward point of view, right? If you enter now because normally when you have these types of pullbacks, how you would look to re-enter these types of strong momentum trades is you wait for, after the pullback, you wait for your first real solid daily candle to present itself. You wait for the high of that candle to be taken out, and then you can look for upside opportunities. Now, if we do something like that on this trade, for this trade to make sense, just at a 1 to 2, we would need to see this get all the way up to, what is that, 7,500 for this trade to make sense. It's too much for me, right? So in the short term, what can we do? The exact same thing that we looked at for things like the Nikkei as well. We can either wait for a possible rotation for the gap fill. The ideal opportunity would be another retest of the yearly pivot. Now, if you don't have the new year pivot marked on your chart for the major indexes, absolutely do that. It is one of the simplest but very effective ways of taking any type of directional bias. Like as long as you are above the yearly pivot, the yearly opening price, basically, or below that. Above that, you want to be bullish momentum. Below that, you want to be bearish momentum. Very, very simple. So the fact that we were able to not just hold the lows at the 100 DMA, but also break and close back above the 100, that is very, very bullish. But I don't want to be buying this thing right at the high. So instead of having it all the way at the lows, you could potentially limit and define your risk just below the yearly pivot. Potentially maybe even using things like the implied volatility level as a little bit of cover. Or alternatively, you can just wait for this thing to prove itself, break to all-time highs, then wait for a pullback, and then look to re-engage. Alternatively, there's some shorter-term levels you can obviously look at as well. If you drop down to like the 15-minute or the 30-minute, there might be some more surgical entries to look at. But the bottom line is, I think there is more upside to be had for equities, especially after the recovery run that we had on Friday. For the Nasdaq, that one is a little bit easier for us, if that is a word that I'm allowed to use. I'm not sure, let's call it simpler. The one that we can look for here instead is a potential break and close back above the yearly pivot. We haven't seen that yet, right? So we could potentially use that as a breakout, wait for a retest, wait for a possible continuation, and then look to limit and define our risk just below that yearly pivot level. If you break and close back below the yearly pivot, you don't want to be long anyway. Right? Doesn't mean we can't recover. Just means that once you flush those levels, the odds of momentum flushing much lower aggressively, it does increase. And you can just see that with the recent price action as well. Now, how can we look to trade this around the NFP? It's going to be messy with NFP, right? Because if it's very, very good NFP data, you would expect things like values and cyclicals to do really well. That means you could potentially look for upside in things like the Dow, as opposed to things like the Nasdaq and the S&P. Alternatively, That also means if it's really, really good data, that there's less chance of Fed cuts, which could again be negative for equities in the medium term. So it's a little bit of a messy one. Similarly, with really, really bad data. Bad data should initially see downside for equities across the board, like we saw with the bad news last week. But at the same time, that also means more opportunity for rate cuts, which should in the medium term be more positive. I'm going to try and not be too fussy when it comes to the NFP and its implications for equities. I think the price action and the momentum last week speaks for itself. And again, if this is all just a flush, a little bit of a squeeze before a bigger move to the downside happens, the yearly pivot remains a key focus point. Once we break and close below that, or for the Nasdaq, if we can't break and close above that, that tells you everything you need to know in terms of momentum and where you need to be careful with this market. So equity upside, definitely something that I'm looking to take advantage of in the week ahead as well. Now, I've got had a couple of charts that I still wanted to run through, guys, but we are heading into the 40-minute mark now. So we are getting close to the end of it. I'll see whether I have time for that, but let's see whether it maybe pops up into the chat, because I do want to go through, had a couple of questions coming out about Bitcoin. So I would like to talk about that as well. But let's just quickly go through a few of the questions before we do that and see how far we get. Right, we've got a quick question here from Sifa saying, what is the ideal new week prep? What are the steps that we need to do every week so we can say we are prepared for the new week? Well, firstly, tune into the Fusion Markets Week Ahead webinar. I think that is your very, very easy win there, Sifa, because we do the work already, right? A lot of the heavy lifting is done. I do these things for myself as well because I am myself a trader, so I'm going to be doing the work anyway. So I think that's the easiest way to go about it. Look for week ahead preps that's already done for you. That's going to save you a ton of time, and it'll also teach you what things to look for, right? So the more and more that you go through week ahead preps, it'll basically show you what different types of analysts are looking at. So I'm obviously very fundamentals heavy. So I'll be looking for the reasons for why things move. So for example, things like the pound Kiwi that I like lower, there's a very specific fundamental reason why I like this thing lower. And then I'm using technicals to overlay where I want to get in and where I want to get out with that particular market, right? So I prefer that way. Then you'll have other week ahead preps that'll only focus on the technicals and not even consider things like the fundamentals. So you'll get a sense of what different analysts like and what they like to look at. And eventually you'll be able to build your own set of things that you want to prep for. But as a high level thing, the first place to start is to look at the biggest move for the prior week and try and understand why those moves happened and whether there's expectation for those moves to continue. Like we mentioned, the pound Kiwi, like we mentioned, the dollar yen, the Nikkei, the equity markets, etc. And obviously the pound. So that's the first place. The second one is you always, always, always have to pull up your economic calendar, right? That's the first or second thing you absolutely have to do is to say that, okay, what is coming up in the week ahead and how could these potential events coming up, how do I expect them how do I expect these prints to impact the associated assets? So whether we are looking at equities or currencies or bonds, whatever it is you're trading, the economic calendar gives you a very good scope of what you need to focus on and what's important for the week ahead. Those two things, I would say, is the most important and a good place to start. But like I said, the easiest win is just to join the webinar or watch the recording. That's already doing a lot of the heavy lifting for you. Right, we've got a quick question here from Bazad. Can the BOJ use possible weak NFP or CPI as a trigger for intervention? Fantastic question. And absolutely, yeah. I mean, we saw this. When was the prior one when this happened? It was with a CPI print, if I recall correctly, Bazad. I think it was CPI. It might have even been NFP as well. But the BOJ has done two things in the past. They've shown us that they are able to use both counter momentum and positive momentum in their favor. I can't remember which one it was, but it was a CPI and an NFP previously where NFP was either good or bad. I can't remember. I think it was really good, and they used that good NFP with a pop to the upside in dollar yen as a catalyst to push intervention. And similarly, the other event with the CPI, again, I can't remember whether it was good or bad. They actually used the positive momentum lower in dollar yen. So when the data came in really bad, they actually used that downside in the dollar yen already as a momentum play and just flushed intervention on the back of that. So those two events is definitely worth watching for possible intervention triggers in the week ahead. Again, where it happens, it's we never know. Between 158 and 160 obviously comes on the radar. But like I say, there's also a risk that these guys, they look at the victory from Takaishi and they're like, you know what, maybe it's not even worth it. Maybe we need to push this even further higher to just save some money. Because again, if she pushes forward this fiscal policy, fundamentally, there's very little reason to like the yen higher. Medium term, right? What makes this tricky is medium term, these fiscal policies should actually be positive for growth, right? If she pulls off what she's trying to achieve, then it should be very good for employment. It should be very good for growth in the medium term. So, there is maybe that medium-term case of recovery for the yen. That's worth thinking about. But yeah, in terms of short-term risks, definitely watch those events as possible triggers for intervention for sure. No stress at all, Sifu. Very, very happy that it was helpful. All right, let's quickly see if we have any further questions here. Um, okay, please quickly talk about Bitcoin. All right, so when it comes to Bitcoin, I'm going to try and keep this short, guys, because we probably want to be wrapping up very quickly. Bottom line, what an ugly looking chart. I mean, as an analyst made a joke in the week, almost fell off my chair as I laughed. They looked at the chart, seeing obviously that Bitcoin dropped 50% in value, and they're like, "Oh, this is what everybody means with the halving," which is it's an analyst joke, okay? But anyway, very very funny, massive drop to the downside, 50% wiped out. Look, I think you approach this from two different ways, right? As a trader, and then obviously as an investor. If you are an investor and you are looking at this, you're probably looking at this as a value buying opportunity, right? You're looking at this as something that, I like this asset in the long term anyway. I would have bought it anyway. And now I get to buy it at a 50% discount, right? I get to buy it at half price. So I think for investors, this is a far easier thing to stomach. And when I mean with investors, I'm not talking about the guy that is, leveraged to his freaking eyeballs in this thing and hoping it goes up. I'm talking about medium-term investors that's going about this the right way, adding small incremental, basically doing dollar cost averaging on the way down and not overexposing themselves with leverage. That's what I mean with investor here. So let me just, phrase that correctly here. So I think from an investor point of view, I mean, me personally, I got lucky. I bought or added some, I think at 63 is where I got filled, or 62. And I just got lucky. I didn't know that we are going to have that very aggressive 17% bounce. I basically just saw the price and I'm like, you know what? I like to add. Yeah, I'll just add a little bit. It wasn't aggressive. It wasn't leveraged. It was long only. So I'm not too stressed about that. That is, I think, the simplest way to approach this. From a trader point of view, man, you have to listen to momentum here. Momentum is ugly. Momentum turned bearish this asset aggressively back in November, and it's been a one-way train to the downside. I mean, think about how. Let's overlay equities, right? Equities was normally um, a very good correlated market to this. Look at the S&P and look at what happened to the Nasdaq, to Bitcoin, right? Whether we had risk on or risk off, Bitcoin was down. Whether we had gold up or gold down, Bitcoin was down. Dollar up, dollar down, Bitcoin down. It seemed like nothing, could keep this market higher. Now, that normally tells you a lot from a sentiment point of view. And the recent data we had last week showed continued outflows in ETF positions as well. So the markets they're basically trimming their exposures by a huge margin, and that should keep, at least in the short term, some pressure going on. to keep things as simple as possible, if you absolutely have to trade this as opposed to investing in it, I think your simplest way is literally just leaning against those key levels. What does that mean? If you are predominantly bearish this market, and you know what, I would really encourage you that it's fine to have a bias on any asset that you are trading, right? It's fine to have a bias, but always listen to the price action and momentum. Especially if you're trading something like crypto, you have to listen to what the price is telling you. So what does that mean? It means that if we get to the next key level of resistance, which is the low going back to April, right? If we get up to 60 or 76 psychological, how can you look to manage that? Well, if you push into that level, and you see bearish activity or bearish signals around that, whether you use doesn't matter what technical instrument you use, whether it's candles, whether it's rejections or support resistance, doesn't matter. If you see bearish activity around that level, you can use that level to lean against. But similarly, if you see clear price action, let's just say you are bearish. If you see very clear price action that sees a daily close and break above that level with a retest and then an extension taking out that high, that is a buying opportunity. It's not a selling opportunity. Similarly, let's just say we wait for a pushback up towards 80.50. That's the next key level of resistance around the November lows. If we get to there and we see a false break opportunity, something that you see a break above, the markets immediately break back below and then retest and take out that low, that can be a possible selling opportunity, and vice versa. If we break back above, retest, push up, take out that high, that offers a buying opportunity. So I think leaning against the levels is honestly the simplest way that you can look to trade something like Bitcoin right now. I would not want to overcomplicate a market like this. Momentum is super bearish, but let's keep an open mind. Let's listen to price action around those key levels, especially for a market like this, which isn't really driven right now by anything fundamental. If it was, we would have seen it correlated to other assets, and we're not. So the fact that it's so uncorrelated and just absolutely getting smashed almost every week, we need to pay attention to those levels, to momentum, to price action. I think that is speaking a lot louder right now compared to the fundamental view. All right, guys, there's still a few questions in here, but I think it's time for us to wrap up. We are getting to minute 50 now for the webinar. If you have any additional questions like the one that's in the Q&A, please just pop them over, whether you respond to a YouTube video or maybe once we've posted this in YouTube, add those questions as a question to the video, and I'll get back to you guys individually. And if it's really, really good questions, we can even do short form videos on the back of that, answering those questions in a little bit more detail if it's warranted. So with that said, I hope today's session has been helpful. I hope you guys can take some of this and use it in the week ahead. If you do, just let us know. It's always great to have some feedback on the back of this. But with that said, have a great week ahead, and I'll catch everybody again next week. Thanks, guys, and take care.